Hello, this is Kim Emery with Kim D. Emery Bookkeeping. Stopping by to talk to you about some 5 common mistakes that owners make with their financial record keeping, hopefully to help you out a little. Number one thing that people do is they mix their personal and their business finances. You need to open a dedicated business bank and credit card account. That keeps everything clean and separated, makes it easier, keeps you from mingling and making mistakes. It also, if you've got them mingled in one account, it complicates things for your taxes. It makes it hard to track your business performance. It just makes it harder to keep track of. So open separate bank accounts, separate credit cards, keep them separated and clean. Second thing is neglecting regular monthly bookkeeping. That leads to errors, lost data, you forget what's going on, go back and look at it. And it's zero real-time visibility into your finances. So keep your regular monthly bookkeeping up to date. The other thing that leads to is then poor documentation, kind of goes hand in hand with that a little bit. If you don't track your receipts and your expenses accurately, you lose receipts. You're skipping expense logs. You're relying on memory. That's not always good. I don't think any of us are different. We have so many things going on, it's hard to remember things. So keep track of all of those things. Keep that documentation done. Snap a picture, a photo of every receipt, attach them to the transactions right away. There's a lot of apps and software that makes that pretty easy to do. Next thing is skipping bank reconciliations. When you skip those, again, when you do it too far in the after the fact, you forget things. And if you're skipping bank reconciliations, when you do a bank reconciliation, it's a way to help keep everything in order, to make sure you haven't missed anything, make sure you haven't duplicated anything, all that sort of stuff. So keep up with those bank reconciliations. They're important, and they're not hard if you keep up with them. Misclassifying transactions and expenses is a big one. If you misclassify things, you can not have your expenses, that you can get those things into the balance sheet, so into an account that doesn't run into your income statement, and that can cause you problems, or vice versa. You can have things that shouldn't be in your income statement that are in there. So misclassifying things and putting them in the wrong places can give you bad information. Even if you have it in an income statement and it's in the wrong category, it gives you bad information and maybe makes it so that you're not making good decisions, because you think you've got inventory costs, and it's not inventory costs, it's office expense or whatever. So you need to make sure your transactions are all classified correctly. Hope that helps. Have a great day. Kim D. Emery Bookkeeping. If you need some help, you can reach me at kimdemerybookkeeping@gmail.com. It's Kim D. Emery, EMERY @gmail.com. And then my phone number is 214-856-6878. Thank you.